Good afternoon, everybody, and thank you, Michael, with a big smile. I don't know whether I'm the happiest central banker, but I certainly feel the most fortunate. I'm the most fortunate because I live in a wonderful country that's able to deliver a remarkably high standard of living to most of its citizens. The review of the Reserve Bank rightly concluded that Australia's current monetary policy framework is fit for purpose. The core elements of that framework are a central bank with operational independence and a flexible inflation target centred on 2 to 3%. In my view, and that of the review panel, these arrangements have served the country well and they should continue. But as times change, we need to change too. The world we're facing is increasingly complex, and it's been right to re-examine how we take and communicate monetary policy decisions and how we're managed internally. So the board and the bank staff have supported the review process, and we've been working constructively through the recommendations. Broadly speaking, the recommendations cover three general areas. First is the legislation that the RBA operates under. The second is how we undertake the monetary policy decisions and how we communicate those decisions. And the third element of the review is how the RBA is managed internally as an organisation. As a result of those discussions, we've decided on the following changes. First of all, from next year, the board will meet 8 times a year rather than 11 times as is currently the case. 4 of those meetings will be on the first Tuesday of February, May, August and November, and the other 4 meetings will be held midway between those meetings. The exact dates of the meetings for next year will be published soon, and we'll publish dates for future meetings well in advance. Second, the board meetings will be longer than is currently the case. They'll typically start on the Monday afternoon and then continue on the Tuesday morning. The outcome of the meeting will still be announced at 2:30 on the second day, typically a Tuesday, as it is now. Third, all board members will have the opportunity to attend an internal staff meeting some time before the actual board meeting itself. This will allow the board members to hear directly from and ask questions of a broader range of staff. Fourth, the post-meeting statement announcing the decision will be issued under the name of the board, not, as is currently the case, the Governor. Fifth, the Governor will hold a media conference after each board meeting explaining the decision, and the media conference will typically be held at 3:30 p.m, an hour after the decision. Sixth, the quarterly statement on monetary policy will be released at the same time as the outcome of the board meeting, rather than on the following Friday, as is currently the case. Given this and the other changes we're thinking about, we're reviewing the structure of this quarterly statement. Seventh, the board, rather than the Governor, will be the signatory to the Statement on the Conduct of Monetary Policy, which is the document that records the common understanding on monetary policy between the government and the RBA. And the new statement is expected to be finalised later this year, and we're currently working on that. Eighth, the board will oversee the bank's research agenda as it relates to monetary policy and aspects of financial stability. And ninth, the bank will continue with its current approach to climate change analysis, focusing on the implications of climate change for the economy, inflation and the financial system. And 10th, the board will work with the Treasury to undertake 5-yearly open and transparent reviews of the monetary policy framework. Together, these changes are significant and they represent a substantial response to the recommendations of the review. Given the lags, economic growth is expected to be subdued over the next couple of years, and it will take time for inflation to return to target. It remains to be determined whether monetary policy has more work to do. It's possible that some further tightening will be required to return inflation to target within a reasonable time frame. Whether or not that's required will depend upon how the economy and inflation evolve. At its next meeting, the board will have an updated set of economic forecasts from the staff, as well as a revised assessment of the balance of risks. The board will also have new readings on inflation, the global economy, the labour market and household spending to help inform its decision. Our priority remains to ensure that this period of high inflation is only temporary. High inflation hurts all Australians, and it damages the functioning of our economy. It erodes the value of people's savings. It makes it harder for businesses to plan, and it makes it harder for them to invest, and inflation worsens income inequality. And if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates and a larger rise in unemployment. That's the reality we face. It's for these reasons that the Board is resolute in its determination to return inflation to target within a reasonable timeframe, and we will do what's necessary to achieve that.
So do you think we are entering a period where real short rates are structurally higher than they've been in the previous period?
Well, it's a very good question, and the truth is no one can be sure here, but I can tell you that this is how I think about it. The real rate being influenced by the underlying rate of productivity growth in the economy and the balance between savings and investment. So is productivity growth going to be higher or lower in the next 20 years than it has been in the last 20 years? I don't know the answer to that. There are some people who think that advances in science mean that we're on the cusp of a new period of stronger productivity growth, which would mean the return on capital was higher, and that would generate higher returns on investment. So that's possible, but the evidence so far is not particularly encouraging for that proposition, with productivity growth having been weak for a number of years. So the other perspective is the balance between savings and investment, and the ageing of the population in the advanced economies will lead to less saving. So that tends to put upward pressure on interest rates over time. The other consideration here is the energy transition. In many countries, countries need to replace their existing capital stock producing energy with a new capital stock to produce and distribute energy, and that's going to create investment demands as well. So the short answer is no one can be sure, and there are factors working in both directions.
Interest rate changes in foreign economies, such as the US, have an important impact on our inflation and exchange rates. So we wonder, and this is the precise question, how much of an impact do decisions made by other central banks have on Australian monetary policy? End of quote.
Yep, that's a very good question. Thank you. I mean, all the central banks are raising rates, or at least most of them, for the same reasons. Inflation's too high, first of all because of the COVID supply disruptions and because of Russia's invasion of Ukraine, and then more recently because of strong growth in unit labour costs. Strong growth in wages relative to productivity, and that's keeping services price inflation high. So that's a common story across most of the advanced economies, and that's why we're all raising rates. We're not raising rates here because the US is raising them, but we're raising them because we're facing the same general economic situation as the United States. So that's how it works. That there is a potential link through what other central banks do through the exchange rate, because if the US was to raise rates and we didn't, then the US dollar tends to strengthen, the Australian dollar would depreciate, and that would bring inflation into Australia. So that could, at the margin, influence our decisions, but it's very much at the margin. We're raising rates because we need to, because of our particular circumstances, not because the US is.